I make it 7 o'clock now. Has Councillor Allen arrived?
No, we're just ringing him, but you're welcome to start if you wish. You're quorate.
Okay, I think I will start in that case. Good evening, everyone. I'm Councillor Jill White, Head Chair of the Pensions Committee at the London Borough of Sutton. I'd like to welcome councillors and members of the public to this virtual meeting of the Pensions Committee on the 22nd of September 2020 at 7 p.m. The Vice Chair of this committee is Councillor Edward Joyce, and he'll take over chairing of this meeting should I lose connection at any point. We're using the technology we have available to ensure we can continue our work as councillors. We hope everything runs smoothly. Please be patient if we hit some challenges during the evening. This meeting is being live streamed to YouTube. Before we move to our first item of business, I'll ask the clerk to confirm which members have joined this virtual meeting. In the meantime, if any member has any declarations, please can you indicate this in the chat function so I can come to you so you may make your declaration. And can I also remind you that when you talk, could you also open your microphone and camera, and when you finish talking, can you close your microphone and camera? I'll pass over to Sharon now for the roll call.
Thank you, Chair. The members that I can see in the meeting currently are Councillor Joyce, Councillor Heffernan, Councillor Weatherlake, Councillor Nanda. Apologies have been received from Councillor Sadiq, and Councillor Drew Heffernan is attending as substitute. I currently cannot see Councillor Eric Allen.
Right, hopefully he'll join during the course of the meeting. I cannot see any members indicating they've got a declaration of interest, so I'll now mention a few points about the meeting. Firstly, I'd like to remind members that exempt items will be taken at the end of the meeting after all the open items have been completed. These are the exempt appendices B at item 8, pages 1 to 4 of the pink pack, item 9, pages 5 to 32 of the pink pack, and item 30, pages 33 to 60. At that point, I'll move a motion to exclude members of the press and public from the meeting under the 1972 Local Government Act. I'd like to bring your attention to the following points. When you're not speaking, please turn your camera and microphone off as this saves bandwidth. I shall allow plenty of time for members to speak on items and shall make this very clear as we move through the agenda. Therefore, please only speak when I call on you to do so. When you speak, please turn your camera on. When you speak for the first time, please state your name clearly before you begin. Councillors should introduce themselves with their title and name. Officers should state their name and title. If you wish to raise a point during the meeting, please use the chat box and type question, debate, or point of order during the meeting. For example, when we come to questions for an item, I'll ask those who wish to contribute to simply type question, and then invite those members to speak one by one. I'll monitor the chat box as the meeting progresses. If you wish to make a point of order or personal explanation, please do so in the same way, and I'll endeavour to move to you once the person currently speaking has finished. We now move on to the minutes of the previous meeting. Members, can we approve the minutes of the previous meeting held on the 10th of June 2020? I'll allow time for members to speak if they wish to raise any matters. If you're happy to accept these minutes, please write yes in the chat box. Thank you. I'll take the minutes as approved, and I'll sign these minutes outside of the virtual meeting after social distancing restrictions are lifted. We now move on to item 5 of the agenda, which is member training. And we've got present 3 members of BlackRock who will be giving a presentation on tilted RI index solutions, which we may want to consider in some of the items in part B of the agenda. I'll now ask Tamrin Rowlands, the director of BlackRock, to present the training, and she'll be supported by Sam Triparaneni and Dovili Silenskait to present this training session. She has actually sent some slides. We've only received them recently, and they have been put out to our emails, I think, in the last hour or so, but she will be presenting to this presentation. So without much more ado, I'll ask Tamrin to make the presentation.
That's lovely. Thanks very much. And firstly, just to say thank you very much for having us join your meeting today. It's very much appreciated, and I hope it's a useful session for you. As some quick intro, so Tamron Rowlands, I'm the relationship manager for Sutton, and I work within our LGPS team here at BlackRock. Dovile, who was introduced as a product strategist within our index equity business, and she'll be doing the bulk of the training and the bulk of the talking. And then finally, Sam is a strategist within our BlackRock Sustainable Investment team. And I thought it would be useful for him to be here today, should you wish to raise any questions or cover any points about our more broader sustainable sort of investing approach, and some of anything that could or would be useful to talk about. But I appreciate we do have a sort of a strict 15 minutes slot. So as much as we can sort of fit in that time to meet what your needs are, we will try to do so. In terms of our plan for the training, so the agenda we have is we're planning to spend some time on covering what is an index fund and how you build an index fund. We'll then introduce ESG and how you can incorporate ESG into an index approach using some simple exclusions. We'll then move on to ESG, the approach of ESG optimized, and what does that mean to optimize an index. And this is one of the sort of, maybe I say newer, but it's not actually that new, sort of newer approach in the last couple of years, sort of the step beyond just screening out. And we'll cover then sort of what does the optimizer do, and finally, what is the impact on the fund or the index fund and the constituents that are within that. And the examples we'll use to illustrate this is an ESG approached fund, and we'll also use our low carbon fund as an example to illustrate for the training. So clearly this is very much training, so please do ask questions through the chair as indicated before, and we'd be very happy to make clear any points and really make sure that this time is yours to get as much as you want out of it, and to learn as much as we can impart. Are there, maybe before we start, were there any questions or any sort of items on that agenda? Or are we happy to proceed?
Can you proceed, and we'll take questions after you finish the presentation.
Okay, perfect. So I will just attempt to share the screen. And just confirming you can see the presentation on my screen. Just checking that that's come up.
Yeah.
Before we start, can I just give my apologies to the chairman for arriving late, but I was tied up in another meeting and I've got here as fast as I could. So sorry for being late.
Thank you for coming as quickly as you could.
Okay, great, thank you. So we shall start on page 2. Double A, over to you.
Thank you very much. Hi, my name is Dovile Shilenskite, and I am Index Equity Product Strategist here at BlackRock. I cover EMEA domiciled funds and index equity strategies that we discuss with our European clients. Just for the disclaimer, I have also dialed in on my mobile ending 85. So in case I have any computer issues, I will try to quickly switch to my mobile so that I'm able to continue the training. But hopefully that will not be required. So on slide 2, we show what the index tracking is. So our index equity funds, all of them track indices that differ between them with respect to what allocations they have to different countries, sectors, sizes, for example, large cap, mid cap, small cap stocks. And the quality of the job that we as portfolio engineers do is measured by the tracking error. That is, we look at the tracking error, which allows us to see how closely we are tracking a specific index that the fund designated to track. If we move on to 3, please. Oh. Okay, apologies. I think I was having some phone issues. Can you hear me now?
David, yeah, I think you're actually better on the previous one. We could hear you fine.
Okay, I'll go back to the previous one.
Tamrin, would you mind just dropping down slide 3?
Okay, so while we are switching to slide 3, what we show on, and apologies for the technological issues. On slide 3, we show the approach that we use to manage the index equity funds. So when we track the index, we focus on risk, return, and cost. With respect to return, all that we're trying to do is we're trying to deliver the return that the benchmark index delivers. With respect to cost, we are doing everything we can to minimize the costs within the fund. And those costs are mainly linked to the trading that we have to do in order to keep the fund in line with the benchmark. And risk is very, very important for us because all of our portfolio engineering and all of the index equity funds have to track their benchmarks very tightly. And without having a full view of a risk, we would not be able to do that. And now I will switch and briefly talk about the different ESG approaches that we see with respect to how ESG is incorporated in index fund. So on slide 4, we introduce ESG screens. We as BlackRock have worked with our clients to identify the sectors that they would like us to screen out. And indexes that incorporate ESG screens, they take quite a, let's say, simple approach with respect to ESG, because all that they do is they say, these are the stocks or these are the businesses that we do not want to invest into. So let's take those stocks out of the index so that the fund that tracks the index is not forced to invest into them. And on slide 4, we outline our baseline screens that are controversial weapons, nuclear weapons, United Nations Global Compact violators, thermal coal, civilian firearms, tobacco, and oil sands. So for the funds, index equity funds that incorporate ESG screens, those ESG screens aim to fall into these areas. And on slide 5, we present a slightly more advanced ESG approach, because here we complement ESG screens with ESG optimization. So what this means is the index provider starts with the parent index, which can be, for example, MSCI World or FTSE All-Share, and then index provider screens out the sectors or the companies or the businesses that need to be screened out. And what needs to be screened out is determined in an index methodology document. And once that's done, then the index provider runs their own optimization in order to keep the new index relatively close to the parent index. So what this means is we are asking index providers to do a lot. For example, we are asking them to screen out big industries, big sectors, and we are also asking them to have the index achieve better ESG score or lower carbon emissions. But we want the index to do all of this within a very tight tracking error. And when we have tight tracking error between the custom index and the parent index, this means that the custom ESG index is still able to deliver risk and return profile that is very similar to the parent index. So when our clients choose to invest into ESG funds that track ESG indices, those clients do not have to give up any of the return, and they do not have to take additional risk, because the index provider does everything they can to keep the custom ESG index relatively close to the parent index. If we move on to slide 6, there you will see a slightly different approach to optimization, because here what we have index provider do is we have them do the optimization that allows the reduction in carbon exposure by around 80%. And all of this is done within 30 basis points estimated tracking error. So if you look on the graph, you can see that 30 basis points tracking error is relatively optimal point for this type of optimization, because it allows us to be at a point where carbon is reduced by a lot. Here we show carbon reduction of around 80%. And all of this is done within a very tight tracking error. So this means that the fund that tracks carbon optimized fund, carbon optimized index, that fund is able to deliver risk and return profile that is very similar to the parent index, which would be MSCI, but it invests into stocks that have much lower carbon pollution. So for the clients that make a choice to go with such approach, they achieve lower carbon emissions, but they do not have to give up returns, or they do not have to be exposed to unnecessary additional risk. And on slide 7, we outline the detail of how that optimization is done. So here you can see that the index provider needs to do everything within 30 basis points ex-ante tracking error limit. And also, for example, country misweights cannot deviate by more than 2%. So if the parent index has 60% allocation to US, then this custom ESG index has a US allocation between 58% and 62%. And on following slide 8, you can see how the custom low carbon index compares to its parent index. And the key difference between these two is the reduction in carbon exposure. So this is exactly what the index promises to do. And this is what it's able to do, because it has an objective of reducing carbon exposure and doing that within a very tight ex-ante tracking error limit. So I know I am at the end of the time. I would like to stop here and see if there are any questions.
Do we have any questions from members? Yes, Councillor Joyce.
So the question I have is that we obviously need to make sure that we don't engage in these type of industry. You say that we don't lose out as a result. Is that correct? Have I misunderstood that? Surely if tobacco stocks turn out to be very profitable, there's no way that we could rebalance that, and we accept that in order to have the kind of investments that we want, that is one of the effects. Could you just clarify that, please?
Yes, that's a very important question. If you go with an index that all that does is it excludes certain sectors, for example, tobacco, then you may need to give up a portion of the return, because yes, if tobacco stocks suddenly outperform the broader market, and if you are investing into a fund that tracks the index that does not invest in tobacco stocks, then you would miss out. Our screened indices do not have any ex-ante tracking error limits. So there, if the stock, certain stocks that are excluded start to outperforming or underperforming, the performance of the custom ESG index may move away from the performance of the parent index. For the optimized indices, That's where index providers' knowledge and expertise comes in, because they review the indices on quarterly or semi-annual basis. So if suddenly, for example, tobacco stocks start to perform really, really well, they would need to do additional optimization within the index in order to keep it close to the parent index. And that's where ex-ante tracking error limits that are defined in the index methodology documents become very important, because some indices give more flexibility to index providers than others. So for example, developed world optimized indices, they tend to have ex-ante tracking error limit of 50 basis points or 0.5%, while emerging market ex-ante tracking error limits may be around 1%. But yes, so based on how the market is performing, the index provider may need to do additional optimization in order to keep the custom ESG index close to its parent index. But this is only done for the indices that are taking an optimization approach. This is not done for the indices that only take screen approach.
Right, we have two further questions. Councillor Nanda would like to know, I think basically how you choose your benchmarks for each investment sector. And we also have a question for Councillor Allen about how COVID would affect your projections.
So when we choose benchmarks, we choose benchmarks that provide the exposure that the clients are asking for and that have ESG objectives that the clients are asking for. So all of our funds that we launch, those launches are done in close collaboration with our clients and in very close collaboration with index providers. Because when we ask index providers to customize indices, we need to make sure that those indices are customized so that they deliver the ESG objectives that the clients are asking for. And with respect to COVID...
And maybe it's worth... Oh, sorry.
Go ahead, Tamara.
Carry on. No, you finish.
Thank you. And with respect to COVID, so I was just going to say that once this crisis started, we saw expanding interest into S and G factors of ESG. So ESG stands for environmental, social, and governance. And prior to COVID, majority of investors and majority of our clients were asking for indices that helped them to address environmental issues. But once COVID became a very big issue globally, social and governance items became a bigger focus. And especially now when we look at how companies are treating their employees, how companies are treating their clients, how companies are working within societies just to ensure that the life keeps ticking on. So those factors are becoming more and more important. And during that time that this crisis has been happening, we started to notice that ESG factors are achieving better returns than non-ESG factors. So the companies that have good ESG profiles, they seem to deliver better returns during this crisis period. Of course, this is a short period observation. There is no guarantee that this will continue in the future, but this is what we are seeing at the moment with respect to ESG.
Could I ask a question? Can I ask how many stocks you have in your index and how you select your stocks?
So MSCI World Index has around 1,600 stocks. And based on which ESG approach is taken, the number of stocks can be reduced to, let's say, 1,500 or even 400. So the indices that take only screen approach, they have more stocks than the indices that need to be optimized and that need to also incorporate the screened approach. So it's very much index specific, and the approach that index is taking specific. But in any case, if the index has 400 stocks or 1,500 stocks, the profile of the index is still broadly in line with the parent index, unless that index is only taking the screen approach, because then it's possible that the custom index may move away from the parent index if the screened out stocks start to experience significant performance.
With so many stocks in the index, how do you ensure the voting intentions of the managers of those stocks in regard to ESG?
Tamara, would you like to? Yeah, Sam, go ahead.
Jump in? Yeah. So just to clarify one thing here. Firstly, it is MSCI who creates the index, and then we as BlackRock create a portfolio to track that index. We then, as the asset manager, hold the voting rights to those stocks. And it is our fiduciary duty to engage with the companies within that portfolio on behalf of our clients. And that is because we are going to be long-term holders of those companies. And regardless of whether we have a specific investment view or not, as long as they are held in that index, then we have to hold them so that we track that index as closely as possible. So we have a long-term view on how we engage with companies because we want to understand what their business models are, but just as importantly, we want to understand what are their material, environmental, social, and governance risks so that we can actually pinpoint with them as we engage with them. Well, if we take an energy company, we believe if we're moving to a lower carbon environment, that you need to be considering transitioning your business model away from fossil fuels. Or as Dovile mentioned with regards to COVID, we want to understand how certain industries are engaging with their workforces more in these troubled times, and so on and so on. So that is how we will engage with them. And then our voting is really a part of that engagement. So we will vote for or against shareholder or board resolutions based on our beliefs on where that company is going and what their intentions are with regards to their business model in the future.
Okay, thank you very much. Are there any other questions? Do we have any further comments from our friends at BlackRock? Anything you've forgotten or we've forgotten?
No, just to say, I mean, this particular approach is definitely an area of focus within LGPS, as you know, and particularly a number of the London boroughs, given the climate change emergency. So this sort of low carbon approach has been quite popular because of this focus on lower carbon sort of emissions, but not deviating too much from the market. To the question earlier, you're not necessarily giving away or gaining anything, but you are sort of continuing to track the index and getting returns in line with the index.
Yes, and I'll just remind members that when we had our true cost carbon footprint exercise last year, that there was a recommendation in that exercise that perhaps we might want to consider a tilted index. But I think that's something for the agenda in Part B this evening. So can I thank our friends at BlackRock very much for attending and for your clear presentation. And we will certainly bear the information in mind in our considerations later on in the agenda. Could I thank you very much? Thank you very much.
Thank you very much.
Thank you.
Right, can I propose we now move on to item 6 of the agenda, which is the Pensions Administration Strategy Review. That's on pages 7 to 24 of the agenda pack. And I think it's Bradley Payton presenting.
Yes, thank you, Chair. So I'm Bradley Payton. I'm the Head of Insurance and Pensions Administration. So this report is to review the strategy for the admin team, so the Pensions Administration strategy, and this review is required every 3 years. So we've used this opportunity to improve the information about the various roles and responsibilities and to clarify the performance standards. And we've done that in accordance with the SIPFA guidance. We've also added in a communication statement, and we've expanded the detail about the recoverable costs. So just to stay briefly with the recoverable costs, so there's one section of that has been expanded concerning scheme employer performance. So to give a live example, we've just finished the publication of the annual benefit statements, and that relies on scheme employers providing us information on certain deadlines to allow us to turn that around and produce the benefit statements for the scheme members. I think historically there's been issues with scheme employers meeting deadlines, and thankfully that's largely resolved now due to the kind of engagement with payroll providers and scheme employers alike. But the issue that we now face is with the quality of the data that's being submitted, which often requires a lot of work by the team in order to turn it around to meet the statutory deadlines to publish the benefit statements. So we're looking to introduce new penalties there for scheme employers that don't submit data that is of satisfactory quality. I guess it's important at that point just to say that it's still our intention to use that as the last resort. So engagement with scheme employers and their payroll providers is our preference, and we'll continue to do that and to look to provide training if that's required. So this revised strategy has been out to consultation to all the scheme employers. Regrettably, there was no formal feedback provided as part of that consultation, although I did receive some informal feedback that was all positive. So this report recommends the committee to approve the revised pensions administration strategy. Happy to answer any questions you may have.
Do we have any questions, members? No, I don't think we have any questions. I think we've covered a lot of this before, actually. So if we just go on to the recommendations, which is to approve the new strategy. Do we approve? Can you put in the chat, members, please, that you approve? Thank you. We approve that strategy. Thank you very much, Bradley. Can we now move on to item 7? And that is, I think, the report on COVID. Yes, and Tamara's giving that.
Thank you, Chair. This is Tamara Bennell, Interim Head of Pensions Investments. So the impact of COVID-19 has obviously been significant for every element of the economy, including LGPS funds, and the pensions regulator has been putting out regular guidance insisting that pension committees and pension boards maintain a focus on areas of risk which could emerge due to COVID-19. These fit into several categories, ranging from sort of short-term cash flow risks and short-term administration hiccups due to remote working, through to investment losses in the portfolio, long-term economic impacts, and impacts on employers within the fund, both the council and other employers within the fund. So we thought it was helpful to set out what we've been monitoring as an administering authority over this period. So committee members and board members can see what we've been looking at and what we've done and what we think we might need to do going forward. In most cases, the impact has been relatively limited. Obviously, there was a significant fall in investment valuations right at the end of March, but that then subsequently recovered during Q2. And the only sort of longer lasting issue that we've seen for now is that a lot of property fund managers have put material valuation warnings on their valuation reports. So making it clear that they are basing their valuations on a very limited data set, because essentially there have been no property transactions in the commercial property sector over the last 6 months. And that is something that the auditors have also picked up on. Other than that, we haven't seen many significant impacts so far, although I think it's fair to say that we are watching quite closely to see whether any employers start to face financial difficulties, and whether members who themselves might face financial difficulties might choose to either exit the fund, stop contributions altogether, or move to a 50% contribution rate, because that obviously would have an impact on the fund's cash flow projections. So we've included some cash flow information. Obviously, that's based on our current known information. We don't have any way of predicting the future in those cash flow estimates, but based on the level of contributions we expect, the level of benefits we expect to pay, and assuming there is no change to those contribution levels, we expect the funds to remain cash flow positive over the next 3 years, and the fund's cash position has remained healthy throughout. This report has been circulated to the board as well for information, and the recommendation is simply to note this report, not to take any specific action as a result of it.
Thank you, Tamara. Do we have any questions from members on this report? Can I just briefly ask, what changes, if any, do you think will result from events yesterday and today, or was it just too difficult to tell? Because I know that although we bounced back in the last quarter, the stock market went down again yesterday. But it seems to be a case where the stock markets go up and down all the time, which makes it even more volatile and even more unpredictable.
I think it's worth pointing out that obviously that the impact is different in different countries. So the UK stock market responds to UK news flow, while events in other countries are progressing on a slightly different timetable. So where you're invested in global portfolios, obviously that impact is somewhat mitigated. Richard, are you looking to come in on that?
Well, I was going to agree with the point you've made, but also just make the boring point, I suppose, that we're a long-term fund and we need to hold our nerve through ups and downs, because we've got a long-term investment strategy that can't respond to daily and weekly jumps. I suppose. So we had a paper last meeting, didn't we, about from Hyman's about the investment strategy in light of COVID, which we agreed to stick to the course that we previously set out on. I'm sure we'll come back to it in a little bit in the performance report.
Indeed. Are there any questions from members, or shall we just approve the report? Can we note the report? Can you put in the chat box to note? Thank you very much. Can we now move on to item 8, which is what we've just been mentioning, which is the quarterly investment performance report. And this will be taken by Tamara and David Walker from Hyman. So over to both of you.
Hi there. Tamara, did you want me to focus on the Hyman's paper first? You're still there.
I think we've lost Tamara. Can you actually go straight into it, David? Because we've lost Tamara.
Yeah. Suggest you do, David. Yeah.
Okay. So there's the cover paper that's been prepared by the officers, and then following that, there's the Hyman's report. So if we start on kind of page 38 of the main papers, the public papers, we've got a kind of outline of the market activity to the period to end June. What you'd note in that is the kind of yellow bars that you'll see across there show that there was pretty much universally positive performance across the majority of markets during Q2. And that's despite, I suppose, the full impact or the initial impact of COVID-19 still to feed through to markets. Markets, I think, we're trying to see through beyond the initial onset of the crisis to see what kind of recovery we expected to have within the market. And that was really bolstered by significant policy action by governments around the world to really support markets with their policy interventions. So what you saw in Q2 was a significant bounce back from the falls in markets that we'd seen during Q1, with global equities up nearly 20% over the quarter. UK lagging a bit, still up 10%. But generally, a significant bounce back in markets from where we were at the end of Q1. and that went beyond equity markets into the fixed income and credit markets, again, partly, bolstered by the policy action by supporting actions from governments around the world that saw, credit spreads come in, bond yields still falling, and therefore kind of positive returns. The exception, I suppose, which was mentioned by Tamara, was property, where there's still, I suppose, significant uncertainty over valuations and a real lack of transactional activity. And that was feeding through into kind of deferrals or in rental collection, impacting on returns as well. And in terms of the stocks and sectors, I think we saw with Q1, though, that some of the sectors that performed well in Q1 also continue to perform well in Q2. And that was particularly in the technology sector. And from a style perspective, we saw kind of quality and growth companies within equities perform well. And that will be reflected in some of the manager performance in the following pages. So turning to the performance of the fund on page 40, the fund overall was up in excess of 14% over the quarter and ahead of the benchmark for the fund by over 2.5%. I suppose it's kind of stark that over the last 12 months, despite the volatility, the fund's still up 6% over the year and 6.6% per annum over the last 3 years. In terms of the relative allocations, the bounce back has meant that the growth allocation is now further overweight relative to target and income a little bit below. Part of that underweight in income has been there for a while due to the uncertainty over property and whether you wanted to invest further monies there, and also on infrastructure, where there's a separate proposal as to how we address that underweight. On the asset allocation in more detail on page 41, again, the relative positioning here partly reflects the relative strong and poor performance of some of the managers and mandates. So the continued strong performance of Harding Loevner, who are your kind of quality growth equity manager, means that they're now significantly overweight or further overweight relative to target, while Schroders, the value manager, where they've struggled, it means they're a little bit behind target. The other parts I've kind of highlighted there of property still being underweight and infrastructure, which we'll come to later on. In terms of manager specifics on page 42, again, I've kind of mentioned that Harding Loevner significantly ahead over the quarter, but now over the year, over 12% ahead of 12% ahead of their benchmark over the last 12 months. And again, well ahead over the last 3 years, whereas Schroders with their value style have continued to lag. And we know there's a recommendation on that later in the agenda that we'll come to. I say property, you'll see quite a kind of range of returns there on property, but I think there has been a spectrum to the extent to which managers are kind of allowing for the write-downs and valuations in the values of their funds, but clearly a more significant underperformance from the LaSalle property mandate relative to the positive performance of BlackRock over that period. The next few pages go into in a bit more detail, and I've kind of touched on Harding Loevner versus Schroders. We've had that comment before. Their value philosophy means that they don't invest in some of the big tech giants, Apple, Amazon, Facebook, Google, Microsoft, and they have been the kind of steady or standout performers over the last 12 months and through the crisis. And actually, there's some, if you actually roll that further forward into Q3, they've continued to perform well. And actually, through the kind of fall and the rise in markets, there's quite a stark or a kind of movement actually in terms of the composition of the global market index as a result of some of these movements and the increased concentration that there is in what are quite a small number of really large stocks. So there's some interesting dynamics happening actually within the market as a result of these relative movements. The next couple of slides, firstly on the diversified growth funds. So there's the Baillie Gifford, the London CIV diversified growth fund, the underlying manager being Baillie Gifford. They have a kind of more diversified mix of asset classes and really kind of struggled in Q1 where kind of risk assets across the board were hit quite hard. But it's good to see performance has recovered quite strongly during Q2. And they're still kind of lagging over the past 12 months, but a kind of stronger period during Q2. Perford, on the other hand, on page 45, also performing well. And they've really kind of shifted some of the risk exposures. Are still predominantly dominated by traditional assets, equities, bonds, and cash, and they have moved those weightings about through the crisis, where they've taken opportunities to kind of add risk or trim risk as things have come back. But we still have them on a negative rating, and that's come back as part of the strategy review. Let's see, property, I've discussed that LaSalle have dragged, but I see there is, I'd say, quite a lot of uncertainty over some of the valuations across the property market. The big kind of split that you've seen is the continued, I suppose, sectoral or shift within the market away from traditional retail and into industrials, and then really the extent of your position, your relative positions across those sectors will have a big impact on relative performance as well. And that's part of the kind of factor that's hit their performance relative to BlackRock, where they've kind of more actively tried to reposition the fund in light of some of those changes in the markets. And the residential fund with Invesco is still in the investment stage. So some of the positive absolute numbers, but they're still in the investment phase of that mandate. So it's still a bit lagging. Partners Group on the infrastructure side, some really strong numbers there, but just a kind of note of caution on illiquid asset classes in terms of the valuations coming through, but certainly some strong performance there over the recent period. And then on the bond side, the final two, so M&G Alpha Opportunities, the kind of sub-investment grade and alternative credit areas really had a poor Q1, but have come back strongly in Q2, helped by the government policy action. And on index-linked gilts, again, they've lagged benchmark a bit, but some strong numbers as we saw gilt yields kind of pushed down further with the falls in interest rate expectations over the period. So that's a kind of quick buzz through the report. Happy to take any kind of questions or comments. I think Councillor Allen.
I'll just remind members that if they want to make any comments on pages 1 to 4 on the supplementary agenda, they should leave that to the end of the meeting, to the part B. But I see we have a question from Councillor Eric Allen, who says that telecom shares do not appear to be improving, despite the fact that most meetings are now virtual. Do you have any comments on that?
Yeah, so I suppose in terms of telecom stocks, there's probably quite a diverse range of types of company within there. And actually some of the ones that have most benefited have been more in the technology space rather than in telecoms. Yes, I think it's been interesting that some of the dynamics caused by the current crisis across different sectors. But I think that, as I say, is probably that they're more sitting in the tech space rather than the telecom space.
We have a question from Councillor Weatherlake.
Yes, thank you, Chair. My question is, how would you describe our overall exposure to commercial property, offices in specifically, and how concerned should we be about the way that sector is looking at the moment?
Yeah, it's an interesting one, Councillor, and I think what we've seen with COVID has probably been an acceleration of a trend that was already kind of well in track. The uncertainty, so I think on retail, we've seen that kind of happening for some time. I think the interesting kind of question is going to be what's going to happen to the office space sector as well, in terms of working practices and what that does. Although it may be that people still want the same amount of space, but they've got less people using it. So it's still quite uncertain. We are trying to kind of, as a firm, think about more a kind of 5 and 10 year outlook as to what those shifts are that we see in the markets and how we think managers will need to reposition themselves. I suppose an example might be the extent to which something like residential becomes a more established bit of the institutional property markets. Clearly, you've got a specific allocation at the moment, but the extent to which that becomes a growing piece of what pension the kind of pension fund property market that you're investing in. So I think there are quite a few kind of structural shifts that we'll see. Some were already happening, some it's really an acceleration caused by the recent crisis.
Thank you.
Any further questions, members? No, in that case, can we recommend to note the quarterly performance report? If you can just put note in the chat function. Thank you very much. In that case, we now have some further visitors. We now have some visitors from the London Civ, and I hope that they've all arrived. Yes, I can see that Jackie's there. I'm pleased to invite Jason Fletcher, the new Chief Investment Officer, and Jacqueline Jackson, the new Head of Responsible Investment of the London Civ, to the meeting. We have got two papers for this. Again, they will be speaking to the main agenda paper, but there's also some supplementary papers at the end of the agenda. And if you have any questions on those, you again will have to leave those to the end of the agenda. Can I ask Jacqueline and Jason to introduce themselves and to introduce their presentation, please?
Can you hear me?
I can, Jason.
Excellent. Thank you very much. I'm sorry, I'm calling in on a phone, so I'm not completely aware of how things are going. Sorry, thank you very much for having us to the meeting today, and particularly from Jacqueline and myself, given we're new to the London Civ. What I wanted to do was, if I give a quick introduction to me and then get Jacqueline to do a quick introduction to her, and then we'll both do our separate parts of the presentation, if that's okay. For those of you that have not met me before, I'm Jason Fletcher. I'm the new CIO. I've worked in both public and private asset management, working for British Airways, USS, West Midlands Pension Fund, and LGPS Central. And in that time, I've worked in active equities, private markets, asset allocation, manager selection, and building investment teams and integrating responsible investment. Whilst at LGPS Central, which is a very similar pool to the London Civ, we managed to take then assets under management from 0 to 17 billion in 3 years. So that's a quick recce on me. If I could then pass to Jacqueline to speak briefly on her background and where she's come from.
Yes, sure. Hello. Nice to meet those of you that I haven't met before. My name's Jacqueline Jackson, and I'm the new Head of Responsible Investment at London CIV, joining mid-June this year, so still very new. Before that, I was at Trucost S&P Global. At Trucost, originally looking after business development in their ESG data and analytics team, and supporting clients, not only corporate, but also financial institutions globally. And then Trucost, as some of you may know, which is a climate change data and analysis provider, which deals with mitigating risk relating to natural resource constraints or broader environmental, social and governance factors, was then acquired by S&P Global. And so I moved to S&P Global with Trucost, where I was the Director of Business Development, specialising in responsible investment, and where I looked after many of our financial institutions clients, both in the UK, in Europe, and across the Middle East and India as well. And so I have good experience, particularly around data and analytics and understanding what different financial industries are institutions are doing within the industry, and what best practice looks like across a range of different asset classes as well.
Thank you, Jacqueline. I was going to go through the first set of slides, which I'm hoping everyone has in front of you. But if I could start before in just saying, I mean, in terms of me starting, my top focus has been very much focused on helping you pay pensions and reduce the contribution councils pay into those pension plans. We're looking to do this by adding value, or the London Civ is looking to add value through the design of funds, the selection of managers for those funds, and then the ongoing management of those assets for you. We're looking to do all of this with integrating responsible investment, which Jacqueline will be telling you a lot more about later, and also risk management and true cost transparency into that investment life cycle. And I'm sorry to say if people have heard that before, but I think that is critical to actually making this work. With that, if we could go to the slides, we've just heard David and Tamara talking about the performance of the funds, so I won't dwell on slide 5. Only thing I would say on these is the Newton fund, which you have, so the London Civ Global Equity Fund, which has been doing a little bit better of late, did actually present at our Meet the Managers on Thursday of last week. I do hope that you were able to attend that, but it was a really useful meeting, which actually had Newton alongside one of our newer managers, the Morgan Stanley fund, which managed the quality fund, or the core fund, as we describe it. But if there's a copy of that, I would recommend people listen to that. Moving to the next slide. Sorry, this is slide 7 on my pack, but this is the one with names of fund launch plans. Wanted to dwell on the funds that are our priorities in terms of launching at the moment. So the first one is the Renewable Fund, which is going to be invested in infrastructure with in the renewable area. 80% of this will be invested in renewable generation, which is obviously going to be sort of wind farms and renewable energy sources, and then 20% is expected to be related to enablers and distribution for renewable energy. So really important funds. We've got over 400 million of interest from London Civ funds. I'm pleased to say that it's just moved from phase 2 to phase 3, which is the mandate development, into the fund restructuring and operational viability. Essentially, this is moving from setting the mandate, which is something that we've done, and the next chart actually shows the mandate that's been agreed for the renewable fund. And essentially, we're moving now into the operational setup of that fund. And from the investment side, the key thing that we're doing at the moment is actually selecting an advisor to help us in selecting the managers that will populate this fund. We're hoping that's going to start. Those investments will be chosen in the new year. So this is something we are looking to develop. We've obviously got another 3 stages to go through. So the manager selection, which we're working on currently, and then actually launch, which again we do hope will be at the end of the year. Wanted to swap to the private debt fund, where the chart actually is a little bit wrong, because actually it's at exactly the same stage as renewables, and we're doing exactly the same thing in there. So we've moved from stage 2 to stage 3. And the key thing again from the investment side is we're looking for an advisor to help us select those investments so that the London Civ can then go and manage them once it's listed. So that is a top priority at the moment, is setting those 2 advisors, and we've actually been meeting both sets of advisors in the final round for that in the last week. And then finally, the London Fund is essentially a fund that's been set with a seed investment group, which is looking to invest in infrastructure and property and some equity investments, primarily in the London area, with an aim of being an impact fund, so improving the social life of Londoners, which I think is something we can all be brought together on. This is actually moving from stage 2 to stage 3 at this point, and is actually a collaboration that we're doing with the with LPPI, London Pension Partnership, and also LPFA as their investor. We have got some commitments from LPFA to invest in this fund, and the aim is again to invest by the end of the year. We do have some interest from our seed investment group, but at the moment most of that looks like possibly being in the second stage of investments, which will be into next year. I would be interested in any other funds that do want to join us in looking at that investment opportunity, so please do come back to us on that. The only other fund I wanted to mention that's in the pipeline that we haven't mentioned here is we're looking at setting up a low carbon, low passive fund, and a seed investment group is being formed on that, and it was discussed at the business update with a number of the potential seed investors in that, and obviously we'd be very keen if Sutton were interested in joining in that. If I could move to the next slide. So I've already discussed renewables and the outline for the fund. So that's all there. And we've also, there's the mandate on slide 11 in terms of the planning for the private debt fund. So if there's any questions on that, we could bring it up later. And then I've been asked to just comment on two of the funds that have a sort of particular responsible investment involvement. And RBC is one of the funds, sorry, the London Civ Sustainable Equity Fund is obviously one of those funds which is very much aimed in the design of the fund to have in sustainability at the heart of what it does. It's managed by RBC. It's got a great reputation for managing these sorts of funds and are deeply engaged with all the underlying investments to not only invest in the right things, but actually engage with them to make sure that they behave better in the future. So improving the E and the S and the G, as well as hopefully making some money from the returns that they make from those companies. So this, I'm delighted, has been doing very well in terms of performance, especially during the COVID down and up, as we just heard earlier from David in his performance report. Then we have the next chart shows a bit about how RBC reflects their philosophy in terms of how they do that sustainable bit into the different areas. And I don't know if people were involved, but we did have a Meet the Managers where we had Newton, which is one of your managers, and also Morgan Stanley, who's one of our newest manager, both talking about their how they deal with responsible investment within the portfolios that they manage for the London Civ and for you. And with that, I think that covers all the things I want to talk about in terms of my introductions and also the current state of affairs in terms of the funds that we're launching. I'd now like to hand to
Can I just interrupt
Jacqueline.
you there a minute, because we have a question in the chat function, Jason, if you don't mind. I've got a
That's
question from Councillor Eric Allen. He says, private debt, is there not concern that this could be a problem as COVID returns?
The private debt has done remarkably well in the environment of the first breakout of COVID, and certainly has recovered very well. There is a concern that it will get worse, and obviously a lot of the support that the government's been giving to companies has actually helped private debt. Actually, the investments hold up better than you would have expected for things which, you would have expected higher default rates. The unknown as we move forward, yes, it is going to be a concern. My hope is with this fund is we won't actually be making any investments in it until next year. My hope, above all hope, is that COVID is looking in a better shape when we start investing, and that might actually be a good time. But yes, it is a concern short term, but pleased to say the fund isn't actually open yet, so it won't be suffering if we are going into a slowdown with the latest outbreak in COVID. And I think Boris Johnson is probably speaking right now, isn't he, on what the plans are? So, which I'm afraid I haven't got access to at the moment. But yes, good point though, and we will monitor it, and that will be part of the selection of the managers, is how they deal with that going forward.
Thank you. I'll now move on to Jacqueline Jackson. Sorry to interrupt there.
Thank you.
Hi, thank you, and apologies for those of you that may have seen some of these slides before, but hopefully it's new information and a good introduction to those who haven't met me yet. I thought it might be helpful just to give a bit of context of the rise of ESG and responsible investment more generally. If you look at the bottom left of page 69 in the packet that you have, you only have to look at whatever year your career started compared with 2020 to see the exponential increase in the rise of ESG. And these are specifically the increasing expectations on reporting. So even since I started, say, for example, at Truecost, the number of policy interventions per year rose from 200 to well over 500 globally this year. And in terms of how that really impacts on London CIV, there are two main areas which we need to be conscious of. We are a signatory of the PRI, and obviously we're very pleased to note that we received a median score of A and then AAB across those different categories. But as of 2021, the PRI have indicated that they will expect TCFD reporting to be mandatory. And essentially the FSB, Financial Stability Board's task force on climate-related financial disclosures, is essentially recommendations around how climate risks should be quantified and also reported. What that really means is that organisations, not just pension funds and asset managers, but also companies, should be thinking about climate in terms of what the footprint is, and then not only setting targets, but understand what the risk looks like from both a transition and a physical risk perspective in a range of different climate scenarios that may take place in the future. So moving traditional methods of footprinting into much more forward-looking scenario analysis type approaches. And then, of course, the UK Stewardship Code as well has changed its approach from a comply or explain to apply and explain, which is a catchy way of essentially saying that they're expecting much more stringent rules around engagement and outcomes-driven approaches to stewardship. And then if you move to the next slide, this is essentially just an overview of a very high level of the approach that we're taking to responsible investment and engagement. So whilst we currently have a policy, which is great, and obviously delighted to have read that myself, I think one thing that I wanted to make clear is that obviously responsible investment is an ever-changing place. The world that we find ourselves in today is very different from this time last year already. And so we want to continuously adapt our approach to responsible investment to meet the changing environment that we find ourselves in. And so on an annual basis, we are going to be reviewing client policies, understanding what our peers are doing in different pools and other leaders within the asset owner space. And then also, of course, understanding what regulation is coming in and what new regulatory expectations will be, and using our investment beliefs to build all of that into our responsible investment and engagement policy. And off the back of that, we hope that we will begin to be able to highlight key areas where we need to go into more detail. So whilst we don't have this yet, things like a climate-specific policy or voting principles will be important. And then being able to really implement them, not only throughout our own operations, but in selection stewardship and through our collaborative efforts as well. And I hope that by 2021, our disclosure and transparency will be a lot clearer. And we're already working with the client services team to try and create more content on the website so that, of course, it's easier for clients to understand what we're doing. And we're working on other ways in order to communicate what we're doing around responsible investment more broadly. And I know Jason's touched quite a lot on funds already, so I don't want to dwell too much on this, but we already have a lot of products available which have a positive impact or mitigate some of the risks associated with key sustainable development goals. But really what we're trying to do is build ESG and responsible investment into the design of new products that meet client needs. And I think just before I stop and see if there's any questions, I think it might be good just to highlight some of the progress to date and some of the good news. So as I mentioned, we did do well in the PRI this year, but of course it's becoming a lot stricter, and they've threatened that a lot of the scores will be going down next year as they make the rules tougher. And so as part of that effort, we are committed to TCFD as part of the mandatory requirements of PRI. And because of that, we're reviewing climate data options in order to build out our ability to understand and report on climate risk, to better meet the needs of, for example, the UK Stewardship Code and the Shareholder Rights Directive, which are coming in. We're also looking at how we will set a voting policy and how we will get more engaged by potentially getting a proxy voting provider. And then from the responsible investment team perspective, we are getting a responsible investment manager or ESG analyst, who I really hope will be able to get us up to speed very quickly in terms of that reporting, but then also hopefully deliver much more value to clients who need some advice or support on some of these services as well eventually. And then of course we've got product launches, and generally in terms of culture, we're really focusing on training, joining groups that help support us through collaborative engagement, such as Climate Action 100+, such as the Diversity Project and Pensions for Purpose. And then, of course, in terms of communications, as I mentioned, trying to find ways of making sure this information is delivered in a concise and comparable way moving forward in a more regular basis, but that's still work in progress. That's all from me, unless there are questions.
Thank you very much. I have a question from Richard Simpson and a comment.
Hi, Jacqueline and Jason. Richard Simpson. I'm Strategic Director of Resources here at Sutton. So thanks for coming to the committee. I think it's really important we get access to you, I suppose I was going to say, and have a dialogue with the CIF. I think we try and do this twice a year, which we've done for a little while. Just some feedback and then a question. So some positive feedback, I suppose, over the last 6 to 9 months. It's felt much more. We felt much more engaged with at an officer level by the CIV in terms of, particularly in terms of new products and how those products can help us deliver our strategies locally. And I know Tamara's been part of a couple of those funds that you've talked about launching, and that's felt much more inclusive. So that's just some feedback from me. I was going to ask a question, particularly about the London Fund that you mentioned, Jason. Are you, given we're all London local authorities with different hats on at different points, both a pension fund one and a council hat, are you at all concerned about a London fund from that perspective, and how you would look to manage any conflicts that may come up about investment in particular localities?
A very, very good question, and it has come up, and it comes up with all pools where essentially it's almost the we may have 32 different funds, all of which would like us to invest in their own particular boroughs. I think most do realise that this is for the good of London as a whole, and I think hopefully everyone will understand that an investment in a neighbouring borough is actually good for themselves. Too. So, but yes, I think we will. I think from London Civ's point of view, we have to look through everything and look at essentially the objectives of the funds. So that is the return objectives, and also the objective to improve the life of Londoners, essentially. So when we're selecting investments, it would need to be done in that way. I think the way it's being set up, we would actually welcome suggestions from local boroughs as for investments that they think would be good. And to be honest, that would come from all boroughs, I'm sure. But I think you do need to give us a bit of airtime, because obviously there will be a lot of sensitivity about people wanting to invest in their own borough. And just as my own declarance of my interest, I'm in the borough of Merton, and I would certainly look out for us not investing in any more tennis courts, because we have quite enough tennis courts in the London Borough of Merton, as I'm sure you well know. But I think it is really important that we are there to actually focus on the returns and the objectives of the fund. We'd look through the individual boroughs in terms of where it's going to be invested. And one of the things that has been said about this is that it's going to be very focused on the centre of London, not the outskirts, which is absolutely not the intention. This is for the whole of London. And actually, to be honest, I think there is an element of it which is allowed to be invested outside Greater London, where we feel there is where investments there which would actually support the Greater London area. So we will do our best to try and manage those conflicts of interest. And I won't be building any tennis courts in Merton, because we've got quite enough already.
I'm sitting in Merton right now, so I can't see the tennis courts, but yeah, I know what you mean. I know what you mean.
The biggest problem is we're not allowed to play on those damn tennis courts. That's the problem. As members of the public.
on the kind of criteria for the London Fund, is that still in the working? I know in the presentation there wasn't a kind of the same level of detail as there is on renewables and private debt. Are you still working through with a kind of a group of officers and members what those criteria might look like in terms of return?
There is a seed investment group, and details very similar to the ones that we've shown for the renewable fund are out there. I'll make sure that's shared with you. I'll get Sylvia. Sorry, I don't think Sylvia's on the call, but I'll get Sylvia to send those over because I think that's all available to anyone. But I'll check that's okay with her. But we certainly all the seed investment group work on what the fund does and the mandate. I'm sure can be shared with you, and I'll make sure Sylvia sends that to you.
Okay, thanks, Jason.
Thank you.
Thank you very much, Jason. Do we have any other comments from members? From my point of view, I'm really pleased that the London Civ has moved forward in the last 6 months. I really feel that we're getting a bit of energy, and that London Civ now understands where councils in London are in the cycle and what their requirements are, and I think this is positive. And we're already a member of several seed investor groups, so we're hoping the relationship can move forward again. Do other members have comments about these Civ products or anything that's been said tonight, either by Jacqueline Jackson or Jason? Any comments? No? Well, I think we'll be considering some of your products in our part 2 agenda later on in the evening. So thank you very much once again for attending this evening. And I'm sure we'll be in contact very soon in regard to our intentions with several of those products, and also in regard to meetings that the Civ is holding. So thank you very much for your engagement with us. Thank you.
Well, thank you very much for having us, and please do ask if you want us. We're here for you.
Thank you. Good to meet some of you. Bye, those I've already met. Have a good evening.
Thank you.
Thank you very much, everyone.
Thank you. Thank you. Thank you, London Civ. So there may be some comments you may want to make later on in the evening when we get to item 13, as some of these projects we're thinking of investing in, but I'll leave that to item 13. Item 10, which is the Pension Fund Annual Report, and I think Tamara is giving this one.
Thank you, Chair, and apologies for dropping off earlier. I've got a terrible cough at the moment, and sometimes I find I can't speak. So thank you, David, for stepping in with the quarterly investment summary. As you know, pension LGPS funds are required to produce an annual report for their members. There is a prescribed set of content set out what must be included in this annual report. It includes the financial statements for the fund, but it also includes its key policy documents like its funding strategy statement, its investment strategy, and its risk management policies. The draft annual report is in your papers. I need to point out that the financial statements have not yet been audited, so they are still subject to revision, subject to audit. The auditors have nearly completed the audit process, and I don't think, touch wood, there are any material issues that are likely to change substantially within the report at this stage. So the proposal is that the committee delegates to the 151 officer the authority to make any amendments that the auditors do finally require, and then obviously to insert the final audit sign-off statement into the annual report. We did have quite a robust dialogue with the auditors over some key issues around COVID, and in particular around valuations of property assets and the extent to which those valuations are robust. Although the auditors were not able to suggest any improved source of robust valuations, so it wasn't a debate that really led anywhere. And secondly, the auditors have also been ensuring that LGPS funds incorporate the latest consultation on the cloud. And I think they were satisfied that our actuarial valuation had incorporated the impact of McLeod. And obviously we know there will be a further sort of workload impact of McLeod down the line, but the financial impact of that is not expected to be material. So if we could move to the proposal to approve the report subject to final audit sign-off and any amendments that the 151 officer deems appropriate to make.
Thank you, Tamara. Do we have any questions on this? No, in that case, can we approve the report? Can you put in the chat function that you approve? Thank you. The report is approved. Can we now move on to item 11, which is member training feedback from National Knowledge Assessment? And I think Tamara's giving this one as well. And that's on page, which page is that one on? 210, I think.
Get the page up myself. So
211. Yeah.
211.
We discussed this knowledge assessment previously, and you were all invited to complete the knowledge assessment. It was in the form of a quiz, and I know there were some comments about both the sort of technological accessibility of the quiz and also maybe the slightly pedantic nature of some of the questions, which made it feel more like a kind of exam that was designed to catch you out rather than a genuine sort of learning experience. But it did cover the 8 areas which SIPFA specify that pension committees and boards are required to have knowledge of and required to have an ever-increasing depth of knowledge of. I think it was useful to highlight to all of us that we need to maintain our skills in all of those areas. It's also worth mentioning that the requirement is that the group as a whole has the required skills and knowledge. So it's not a requirement that every individual has every single element of that knowledge. It is a requirement that the committee and the board as a whole, between them, have sufficient knowledge and experience and skill to exercise their functions. So in Appendix A, we got the results back from that survey. And I think we were pretty much sort of in the pack with other local authorities in terms of the scores and had a very similar profile of strengths and weaknesses when compared to the average fund. I think there were areas where I think we could look to do further training, particularly around pensions administration and actuarial methods and practices. And I think that was also corroborated in the free-form text responses at the end of the survey, where people were asked, what would they like more training on? Those were definitely areas that came up as well. So the training plan is proposed, I think it's page 16 in the appendix. The training plan is proposed starting from the next quarter through to the final quarter of the next financial year. And I think broadly it's sensible. We perhaps will need to tweak the timing slightly in terms of when government guidance comes out on specific issues, on governance in particular. There may be a slight difference in timing versus what Hymans were assuming when they put together this training plan. But I think broadly it covers the key areas where we've identified there might be a requirement for further training. We'd be interested to hear the comments of councillors on the survey itself and whether they felt it was a worthwhile exercise and something we should look to do again or not.
Thank you. Do we have any comments, one about the survey and two about the training programme? And it's worthwhile saying that the training programme is actually summarised at item 4.5 on page 212 of the agenda. So one of the points of the survey, I think one of the misgivings that I had was the fact that everyone was lumped together in it, that we were asked the same questions as those who are on the board, and I think council officers as well, when I think we would have benefited if we had our own questionnaire that reflected what councillors actually do, and the board had their own questionnaire and what the board actually does, and officers have their own questionnaire and what officers do, because what we do is slightly different. And I think that was one weakness of the survey, that it did lump everyone in together, and as Tamara said, it was very pedantic rather than high level, and what councillors look at is high level. And I see we've got some questions in the chat box. Eric, do you actually want to ask your question?
Yes, thank you, Chair. Could we do our training sessions separate from the committee meetings? I do feel that we're trying to cram an awful lot into one meeting. I, for one, would be quite happy to have 2 meetings per session rather than just one very long session, because as we all know, attention tends to drift after the first couple of hours, and it would be better to actually have our training sessions separately.
Can I just come in on that? The board have also had a similar discussion and are quite keen to have joint training sessions with the committee and board together, perhaps during the day rather than in the evenings, particularly while we're working virtually. I don't know whether that makes it more or less feasible for people. But yes, they've asked for those joint training sessions if possible.
Yeah, I would be happy with that. But it's down to Jill to make a final decision.
Maybe we'll have a look at that. Councillor Weatherlake, what's your view?
Yes, just to say that I agree with what you said at the beginning. It was it seemed like a very unspecific way of approaching the question. I think a more tailored approach would have been more beneficial.
Thank you. Councillor Nanda, do you have some ideas as well?
I think I echo Eric's view on that. I think like how we do other planning trainings, we should have this training separate, and it is a little bit tiring process as well. When you're doing it, I thought it's like a simple process, half an hour things, but it was a little bit complicated. But I would try another go at as well after a little bit more training. Yes.
Councillor Joyce, your views?
Well, all I was going to say is I'm extremely grateful for the training being outside of working hours, but I do appreciate that other members of the committee, particularly those who are retired, would rather the training was at a different time. But for me, as a working person, having them after 7 is very helpful. So if there's a balance, I don't know.
Okay, Councillor Heffernan, as a substitute member, what's your view?
Thank you, Chair. I think coming at this from a sub's point of view, I think Councillor Allen's idea of having them separate to the meetings is quite a good one. I personally, I've been on a sub for 2 years, but not actually attended a meeting. I wasn't aware that these training sessions happened as part of this meeting. And I think it would make more sense to have joint training, and particularly if I know we mentioned earlier on that actually the need for these skills is a need across the board and across the committee. It's not that each person needs to know everything. And I think those joint meetings might be more useful to make sure that we can across the group have everything ticked off. So I think, yeah, if we could do that, it'd be great.
Okay, David, can you comment?
Yes, I'll just say that, I think separate training, I think, a kind of really long session can be kind of hard going for everyone to get through and kind of keep engaged. I think particularly virtual, we found it has been easier to arrange, a kind of 1 hour call at a time that suits trustee and committees to allow that flexibility. And the only other thing to note is, and this isn't a hard sell by any way, but we are in the process of developing training videos that are available to watch at a time that suits committee members. And so that was something we've been trying to build in, so there is that flexibility that people can carry out the training as and when it suits them.
So it could be done on an individual basis rather than a group basis. So if most people are available during the day, they could do it together then. But if other people were only available in the evening, they could, in theory, catch up by doing it on their own. And I think it's still better if we all do it together, because then you could bounce off each other.
I agree, Joe. But
yeah. Any other comments on the training? Are you happy with the subjects that have been chosen, which did relate to the survey results? They seem to be fairly broadly acceptable. In that case, I think, what are we asked to do? We're asked to agree the proposed training plan. Can you put in the chat line that you agree with the proposed training plan? Thank you very much. That leads us on to item 12, which is review of work programme.
And I think that is me again.
Yeah.
So the work programme is set out in the report. It was based on incorporating training into this meeting, but I think we'll take it away and look at the extent to which we can set up separate training sessions on specific topics outside of the main meeting. I think that is a very sensible suggestion. I don't think there's much there that would have changed significantly, except that I've added to the agenda for the next meeting a discussion of liquidity management. And obviously we know the pensions regulator is focusing very closely on how pension funds are managing their liquidity during the pandemic. But also as we move our investment strategy towards unlisted assets, which might have sort of illiquid drawdown profiles or prepayment profiles, as we've seen with our existing infrastructure investment that has paid back, and then we need to have a strategy in place for what we do with the cash when we receive it back, and make sure we're fully invested at all times. It's becoming increasingly important for us to have a dedicated focus on how we manage cash and short-term liquidity, not just as a sort of one-off exercise, but on an ongoing basis. And then the other item that I have added to the agenda is the investment strategy statement, which we need to produce. The last one was produced at the beginning of 2017, and we need to update that. So once we've finalised our investment strategy implementation plan at the end of this meeting, we'll be in a position to start producing the next investment strategy statement, which we're required to publish for the public. So those are the two items that I've added to next meeting's agenda.
Any comments on the agenda for the next few meetings? No. In that case, can we agree the proposed work programme? Can you put agree in the chat function once again? Thank you very much, members. In that case, the only thing I need to say now is that we have no items at item 14, which is urgent items, in which case we can now close the open part of the meeting. Items 8, 9 and 13 contain accept information, so we will need to consider these in the closed part of the meeting. I will therefore move that the public and press be excluded from the meeting for the following item of business on the grounds that they involve the likely disclosure of exempt information as defined in paragraph 3, Schedule 12A of the Local Government Act 1972. Please may I have a seconder for that motion?